They pulled out $45 billion from the Indian stock market in just 18 months. That's roughly 4 lakh crore Indian rupees gone since October 2024. And the selling hasn't stopped. Is it going to hurt your wallet? Who are these people that are moving money away from India, and why are they doing it? In the next few minutes, I'll answer all of these questions in the simplest possible way. So stay with me and we will unpack what's happening in the Indian economy, as it affects far more than just the stock market. The story begins in October 2024 when FIIs started exiting the Indian stock market. FII stands for Foreign Institutional Investors. Simply put, these are funds that invest in the Indian stock market but are based out of India. These could be foreign mutual funds, insurance companies, pension funds, etc. So these FIIs sold Indian stocks worth more than 1,10,000 crore rupees in October 2024. And this year alone, these entities have dumped Indian shares worth more than 2.2 lakh crore rupees. The question is, why are these people taking their money out of the Indian market? The story is more complicated than foreign investors simply abandoning the India story. Now pay close attention, because the answer has two aspects. First, by nature, FIIs chase returns. It's in their DNA. After all, they are not running charities, are they? In simple terms, if a foreign mutual fund, pension fund, FII sees high returns in an Indian company, it will buy its shares. But if the same fund finds another company that's giving even higher returns, let's say in Taiwan or South Korea, it will not think twice before dumping Indian stocks and moving the money to the other country, the other company. Chase the profits. That's FII logic. Now this brings us to the second part. Why are FIIs not able to spot opportunities in the Indian stock market? There are multiple reasons. First is the huge demand for AI. Countries that are leading in semiconductor manufacturing are emerging as the biggest winners. Taiwan and South Korea are two such examples. Secondly, as you might remember, many analysts had been pointing at expensive valuations of Indian stocks. Simply put, if an Indian company's earnings are growing by only 10 or 20%, while investors can get 70-80% returns elsewhere, why will they stay in India? FIIs will eventually move out. And that's exactly what's happening. Do you feel Indian stocks are still overpriced? Drop your reasoning in the comments below, and if sharp geopolitical and money insights interest you, then subscribe to GlobalOpEd right now. The third reason why FIIs are dumping Indian stock is the weakening Indian rupee. If the Indian currency weakens, then that's a loss of profit for the foreign investor. Investors also look at taxes on stock market profits. India currently taxes short-term stock market gains at 20%, while long-term gains above 1.25 lakh rupees are taxed at 12.5%. For many foreign investors, higher taxes combined with expensive valuations can make other markets too more attractive to ignore. Finance Minister Nirmala Sitharaman recently said that the government is willing to listen to concerns around these taxes. And this brings us to the most important question. Does FII outflow hurt your wallet? FII outflows certainly pressure the Indian rupee, making imports expensive. And we can see the effects of that by way of fuel price hikes, and that's directly hitting your wallet. FII outflows can also cause volatility in the stock market and dampen investor sentiment. That is already reflecting in your portfolios. Although most economists agree that India's economy is structurally well placed, but the current crisis also means that India cannot afford to be complacent at this stage, because growth and prosperity are not fundamental rights. India will have to fight its way into the world of developed countries. Do not forget to subscribe to GlobalOpEd and share the video with your friends. Until next time.